In section 2, you're going to be learning how to analyze an income statement. We'll still be using our income statement from section 15.1, and now we'll be looking at the values on the income statement and determining an analysis of the company. We do this process through a component percentage. And a component percentage is a relationship between one financial statement item and total net sales. So as you're looking at some of this chart down here, you have your sales, and the acceptable industry standard for sales is always 100%. And sales is divided by sales, which you would have the same number for the numerator and the denominator. Cost of merchandise sold. Acceptable industry standards say that the value of your merchandise sold should not exceed 46%. Not more than 46% is acceptable. Since you have calculated a component percentage of 44.9%, this is not more than 46%, so this would be acceptable. Industry standards say that gross profit on sales should not be less than 54%. Again, looking at our company Hobby Shack, the ratio is 55.1, so this would also be acceptable. Total expenses should not be more than 35%. Since we have a ratio of 33.9%, this again is acceptable. Net income before federal taxes should not be less than 19%. 21.2% is not less, so that is an acceptable. So when you're determining acceptable rates and whether ratios mean anything, it's very important to look at the acceptable industry standards and compare your company's ratios to the industry. You also look at prior years and you see how ratios have changed over the years. This is an example of an income statement showing a net loss. The gross profit of $351,195.98 is less than your total expenses of $393,000. Losses are shown in brackets, as we have here with the $41,769. Federal income tax, since you had a loss, it's referred to as federal income tax benefit, and this number would get added to your loss to show your net loss after taxes of $35,000. Again, since it is a loss overall, it will be shown in brackets. When you're looking at the component percentages, you compare them to the industry averages. And the acceptable component percentage for the industry for cost of merchandise sold should not exceed 60%. That means that whatever your cost of sales is, dividing it by your net sales, it should not be more than 60%. Since we have calculated out 58%, this would be an acceptable component percentage. The industry average for gross profit, the minimum acceptable for gross profit is 40%. Since 42% is our calculation, this again is an acceptable percentage. The industry average for expenses is 37%. That means your expenses should not be more than 37% of your net sales. We calculated 47%. 47% on expenses is higher than 37. This is not an acceptable ratio. And it's probably because of these expenses that your business has not performed well. management has not done a good job in controlling its expenses. What you would do is look at all of the line item costs on your income statement and find a way to reduce expenses. Looking at this income statement further, one other thing that I wanted to point out is that you had your loss showing up with brackets around it. This loss shows that for every 5 cents of sales, you've lost 5 cents on every sale that has been made. And it's mainly because of your expenses being overstated. So there's some actions that you can take if you do have unacceptable component percentages. One thing is if you have an unacceptable gross profit, one thing that can happen is that you should increase your sales revenue. Because remember, a calculation for gross profit is sales minus your cost of goods sold. If you decrease the cost of your goods sold, that's another way to fix your gross profit. If you have an unacceptable component percentage for expenses, you should evaluate major increases. Look from the prior year compared to prior period, and also look at industry standards and see what is an acceptable amount to spend on your expenses. Remember, ratios are comparison between two items of financial information. One ratio analysis that you can do is to calculate out your earnings per share. This is also referred to as EPS. This is your net income after federal income tax divided by your number of outstanding shares of stock. You compare this calculation to prior years, see how it has changed, or look at the market price of your stock for evaluation purposes. Another calculation ratio is your price earnings ratio. And this is the relationship between your market value and your earnings per share. The market price per share is divided by the earnings per share. You'll now be completing section 15.2 work together, which is on page 460. In step 1, it says that no more than 53% of each sales dollar should be devoted to cost of sales. We have 51.9% as our answer. So 51.9 is not more than 53%. So yes, this is acceptable. To calculate out the 51.9%, you would have taken $282,539 and divide it by $544,814.72, your total sales. This came out to 51.85. Remember, we needed to round to the nearest tenth of a percent, making this be 51.9. The industry standard for gross profit says that at least 47% of each sales dollar should result in gross profit. You calculate this by taking your gross profit on sales, $262,275.68, and divide that by your net sales of $544,814.72. This calculates out to 48.1%. 48.1% is at least 47% of each sales dollar. So this was an acceptable ratio. Your expense ratio of 33.9 was calculated by taking your 184,000 total expenses, dividing it again by your net sales to calculate out to 33.9%. Your net income before federal taxes, 77,511.14 divided by your net sales again of 544,814.72. Notice in every case 544,000, which is our net sales, is always your denominator. Your earnings per share is the amount of net income after federal income tax that belongs for a single share of stock. So you take your net income of $62,907.35 and you divide it by your outstanding shares of stock, which in this example in step 3 it says 110,000 shares of stock. This calculates out to 0.57. It means that for every share of stock that you own, you earn 57 cents per stock. The price earnings ratio, also referred to as the PE ratio, is the ratio of the current market value of your stock compared to your earnings per share. The market value of this company is $13.75. The earnings per share was 57 cents, calculating out to a PE ratio of 24.1. Generally, low price earnings ratios are typically associated with slow growth companies, whereas high PE ratios show dynamic growth for future. The best way to look at these ratios is always to compare from prior years and seeing how the value is changing. If it's increasing, this is a good trend.